Hi, good morning, everyone. I hope you're all doing all right, considering what's going on in the country. Today, we are going to be talking about the costs of production, and we started our discussion on this in the last on-campus class, but we didn't end it. So today, what we're going to be doing is we're going to be using the slides to actually go through this chapter. This is going to be chapter number 13 of the book Principles of Microeconomics by Gregory Mankiw. The chapter is going to be about costs of production, and before we get to the whole idea about what costs of productions are, there are a couple of questions that are important that we review before we continue on with these slides. These questions are going to help us understand what the chapter is about. So what I'll do is I'll just quickly read them out to you so that in editing this video I'll see if I can add it on the slide as well, so that when we're actually going through the lecture we understand what the discussion is about. By the way, these questions are going to be are the review questions that you find at the end of the chapter. So let's quickly go through them. And first one is, what is the relationship between a firm's total revenue, profit, and total costs? We should be able to give an example of what an opportunity cost is, and why might an accountant not consider opportunity cost as a cost? What is marginal product, and what does it mean that when you say that the marginal product is diminishing? We should be able to draw a production function that exhibits diminishing marginal product of labor, and we should be able to associate the fact that when productivity diminishes with additional laborers, the cost of productivity goes up as we increase, or in other terms, the marginal cost increases as the quantity of things that we're making goes up. Besides this, you should be able to define what total costs are, what average costs are, and what marginal costs are, and how they are related. You should be able to draw the marginal cost curves and the total average cost curves for a typical firm, because these cost curves are eventually going to be used by us when we discuss individual markets. And we should be able to, by the end of this session, be able to distinguish between long run and short run total average cost curves. And finally, we should have an idea of what economies of scale are, and why economies of scale might occur. And besides the economies of scale, we need to know about what diseconomies of scale are and what constant returns to scale are. So that's the basic plan for the day. We'll be covering this chapter so that we can eventually answer these 8 questions that I've just gone through with you. So let's just start off with the chapter. So this is stuff that we have already seen, so we'll try to keep it to the bare minimum. So what is total revenue? Recall that before coming to this chapter, we've covered the demand and supply model, which is a relationship between prices and how much quantity is being demanded and supplied. So total revenue is what the firm receives after the sale of its product. And so it's basically the price of a product, the unit price of a product times how many units you end up selling. Total costs is the market value of all the inputs that the firm uses to actually produce stuff. And finally, profit is basically the difference between total revenue and total cost. What is opportunity cost? So when it comes to costs can be divided into two kinds of costs. One is a cost that results in money going out of the firm, That's called the explicit cost. And besides this cost, there is another cost which is called an implicit cost. So the cost or the opportunity cost is the cost of something. Uh, so the opportunity cost is basically the cost you give up to get something. And so basically, when you decide to run a business, you could have uh, invested your time into something else. Maybe you could have freelanced, and under that freelancing job, you could have earned some money. So when you decide to do a business, you are trading off, and you're basically saying that I will be doing a business instead of doing freelancing because I feel as if I can earn more doing the business compared to the freelancing job. So when it comes to an accountant, the accountant will always think about costs in terms of how much money is going out of the company or the firm, whereas an economist will think of costs as in terms of the money going out as well as the opportunity costs as well, which not involve physical cash going out of the company. And the idea behind using or behind the economist including this opportunity cost in the cost of production is that if let's say the returns from doing this freelancing job goes up, you might end up deciding to not continue your business anymore. So, for an economist, it is important to include those costs that are implicit and don't particularly specify or are limited to cash going out of the firm. So here's some definitions about explicit and implicit costs. Input costs that require an outlay of money are called explicit costs. So whatever costs that result in money going out of the firm, this would include paying the workers, paying the rent, paying for the machines, paying the entrepreneur, and stuff like that. Implicit costs, however, will not require an outlay of money by the firm. And as I discussed with you, that is ignored by accountants, but for us, we'll be considering total costs as explicit costs and implicit costs, both combined. You could have decided not to invest it, and from using this money, you could have actually gotten some return, some interest income, which you will not get because you've actually invested the money into the business. And the fact that you're not getting this money is not incorporated in the calculation of an accountant. Economic profit, therefore, would be different from an accountant's profit, since profit is total revenue minus costs, and an economist is interested in studying how firms produce and how pricing decisions work. We are going to be including both explicit and implicit costs. This would therefore mean that an economist's profit is going to be smaller compared to an accountant's profit. Therefore, if this was an accountant does not consider the implicit cost as a cost. So therefore, for an accountant, the bigger portion is going to be the profit compared to an economist. We've discussed this example where this guy invests 50,000 in a business, which he could otherwise have invested, put in a bank, or bought a corporate bond against which he would get 4% interest returns. And the example talks about how the company has a revenue of 120,000 where the outflow of cash is 110,000, and based on an accountant, the return should be the profit should be 10,000. However, when an economist tries to calculate the returns, he's thinking about uh, the total revenue and then subtracting the explicit costs, which is the cash outflow, and then subtracting whatever was the opportunity cost as well out of the equation. Therefore, an accountant's profit would be 10,000, while the economic profit would therefore, when you deduct 2,000, which is the interest income, it result in 8,000 being the profit, which is smaller compared to an accountant's profit. Now let's talk about the production function. Um, Firms use land, labor, capital, technology, and produce stuff. And a production function basically tells you the relationship between what goes into the production process and what comes out. The production function basically discusses the relationship between inputs and outputs, and what quantity of inputs go into the equation versus what comes out. And what we find is that as quantity of production goes up, the production function normally flattens. And the fact that it flattens has something to do with the functional form of the production function, uh, and also has to do with productivity of the inputs that are going into the function. And the marginal product basically explains this idea of why the production function flattens as quantity increases. Um, because this relationship basically talks about how output Y is affected by an input, and then the input in this case could be labor, or it could be how many machines you're adding into the equation. And we find that as you add more inputs to come up with an output, the the productivity of the inputs basically falls as more and more is being produced. And this idea is called the diminishing productivity or diminishing marginal productivity. So for every additional unit of input that you put into the production function, it results in the output increasing. But when we say it's diminishing, it basically means that the productivity of that additional unit falls over time. So because of the fact that the these inputs, labor and capital, have diminishing marginal productivity, that's why the first person that you hire to make stuff helps you increase productivity by some amount. The second person also results in productivity increasing, but by a diminishing amount, by a smaller amount. So that's why for every additional person you hire, productivity keeps on increasing, but by a little less. And eventually you come to a point where adding more inputs or more people or more machines into the equation does not help in increasing the output at all. And this basically would therefore help us kind of figure out how many inputs should we be adding into the production function. So if you take a look at this, what I ideally I would want is that we um, have you actually look at this. And so let's look at this production function and total cost of Caroline, who's running a cookie factory. So we're basically looking at production, and we're trying to figure out how what happens to the productivity of the labor as you add more as you add more workers into the mix. So first column is about how many workers you have. When you have zero workers, the output is obviously going to be zero. So you're not producing anything. When you let me just use a different color over here. Yeah. When you end up hiring one person, the firm starts to produce 50 things. Notice that you've jumped from 0 to 50. So this additional person that you hired this marginal person that you hire resulted in the output increasing by 50. So that's the marginal product of this laborer. Then you decided to add another person, another marginal laborer into the production as an input, and you ended up having your output increase to 90. Notice that after adding a person, your output increased. But how much did it increase by? It increased from 50 to 90. This is basically 40 uh, additional cookies were produced per hour. Then you decided to add another person, and when you added the third person, it resulted in the output increasing from 90 to 120 cookies per hour. But notice how this third person only helped add in the productivity by 30. The fourth person caused productivity increase by 20, the next by 10, and you notice how the productivity of every additional laborer that you hire into this process or add into the input for producing cookies results in the output increasing but by a smaller amount. So you notice how the marginal productivity of the laborer falls as quantities increase. But what is important to remember is that when you're adding more laborers, output is actually increasing, but by a smaller amount every other time. So uh, because of the fact that when you add new laborers, output increases, but by a smaller amount, that's why the production function flattens. And eventually you'll come to a point where adding the next person, the seventh person maybe, will not result in output increasing at all because in this case the marginal productivity of labor is going to be zero. And that is when you'll decide, you can actually decide that look, six or seven is the hiring. It doesn't make sense to hire the seventh person because he's not causing, resulting in the output increasing. So by this way, looking at the marginal productivity of labor, you can actually decide that the firm should be using six people as an example in this case. Now that we've talked about marginal product of labor, let's just look at the cost side of things. So we've talked about this. Uh, Maybe we don't need this for the cost portion. Notice that when you are producing cookies, you you need a factory and you need workers. Column 4 and 5, and the factory is a fixed cost, and a fixed cost is a cost that does not have any relationship between what is being produced, whereas the cost of workers would obviously be linked with the output of the firm as well. And the total cost is basically summing column 4 and 5 up, which is the cost, the variable cost, and the fixed cost together. So the cost of workers is the variable cost, and the fixed cost is the cost of the factory, and you'd end up with the total cost of inputs. Before we move forward, let me just recap. What we're saying is that as you add more workers into the input process to make more cookies, you will end up with making more cookies, but every additional labor or person that you hire to produce cookies will result in output increasing, but by a smaller amount. And this smaller amount will keep on decreasing till a point that you come to till a point that you adding further people into the mix will not result in output increasing at all, and that will actually help you understand or decide as to how many people you should be hiring or to produce the cookies. And this idea is called the diminishing marginal productivity. And in our case, since we're talking about people, labor, this is called diminishing marginal productivity of labor. The marginal product of an input declines as the quantity of input increases. So what we said earlier, if as the number of workers increase, every additional worker contributes less to the output. Therefore, output does increase, but by a lesser amount. And that is why the production function gets flatter as more inputs are being used. And consequently, the slope also changes. Eventually, you end up with a flat line. Production function flattens. As far as the costs are costs, so this is the production function. Notice that the first person added 50, the second person added 40, the next person added only 30, the next person added 20. So each additional worker that was hired contributed less. Each additional person that was hired contributed in output going up, but by a smaller amount. So slope of this thing is flattening. Eventually, you this will become flat, and when it becomes flat is when you say that adding the seventh worker does not cause output to go up. So it doesn't make sense to actually hire the seventh person. Um, these two curves are important to understand because you notice that as the number of workers as the input increases, the output increases by a smaller amount. This says something about marginal costs. So for every additional worker that you hire, he becomes more costlier for the firm because this first person, if you are giving him, let's say, $10 as his wage, he was producing 50 uh, cookies. The next person that you hired, you were still giving him $10, but he was only producing 40 cookies. This so the next person, this guy that you hired, you were giving him $10, but he was only making 30 cookies. So if you think in terms of costs, on average, these 30 cookies cost 3 rupees per cookie, and not 3 rupees actually. It was zero. So if you look at these closely, you realize that um, the cost of making cookies over here was actually 0.3, whereas the cost of making these 50 cookies on average was 0.2. How am I actually calculating this? I am dividing 10 by $10 was the cost by how many by the cookies, and I'm coming up with 0.2. Whereas over here was 10 divided by 40. Third was this case. In this case, when you added the sixth person, still paying him $10, but he was only helping in contributing maybe 5 rupees into the process. So basically, sorry, 5 cookies into the process, which was basically therefore mean uh, this would be the cost. And you notice how as you go up, the cost keeps on. So the first person, since he was actually helping us produce 50 cookies for $10, the next person was making 40 cookies for $10. The next person was making 30 cookies for $10. The last person was only making 5 cookies for $10. So you notice how the cost keeps on rising as you hire more and more people and as you're producing more and more stuff. So that is the reason why this curve is going upwards. If you go back, total cost curves are the relationship between quantities produced and the total cost. And it gets steeper as the amount produced rises. And the reason behind is that productivity exhibits diminishing behavior. Producing one additional unit of output requires a lot of units of input, therefore being more costly. I hope you understood this. This was something that we got stuck up with in the last class. Hopefully, this way we are, uh, this time we'll be able to understand why the cost curve becomes steeper as productivity goes up or output goes up. Let's just start our discussion on costs. Understanding these costs and then actually using them uh, is important because eventually, when we shift from when we start our discussion on um, how individual firms behave in their different markets, that's where this stuff is going to be coming handy. So let's start off with our discussion on costs. So some of the stuff I would like to imagine that you already know. So fixed costs are costs that are not kind of related with how much the quantity of production is, which basically therefore suggests that as since you're looking at costs over here and you're talking about quantities, as quantity of production increases, the fixed cost does not change, so it's like a flat line. So that's basically fixed costs, and fixed costs therefore do not depend on quantities. Variable costs, on the other hand, vary with how much is being produced. So if you talk about costs and quantity in the context of variable costs, you realize that when nothing is being produced, the cost is zero, and but when you start producing more, the variable cost keeps on increasing. So this is called the variable cost. And the total cost is basically these two things, the variable cost and the fixed cost added together. And if you were to plot this on a graph, total cost would basically be something that starts on a higher place because you're basically starting from this point and then going up. So this would what total cost should look like in reference to what is being produced. Um, Average costs are probably the things that are a little more important for us in this course compared to the fixed costs. And average is basically the total cost divided by how much is being produced. So that's your total average cost. Fixed cost, on the other hand, is about total fixed cost divided by how much is being produced. And this basically will give you average fixed cost. Variable cost, on the other hand, is related with total variable cost being divided by what is being produced. And this gives you average variable cost. What is important for this course is that you be able to see that since fixed cost is fixed and if quantity keeps on increasing, if you somebody were to ask you to draw a graph of average fixed costs and quantity, because since fixed cost is not changing, the graph should be something that is downward sloping. That is what your average fixed cost curve should look like, and it's probably never go meet the x-axis. So once again, what we're saying is that since fixed costs are is fixed, and as you keep on producing more and more, this number starts to become larger, and since this is a constant number, the value of average fixed cost falls. That's why the graph is downward sloping. The average variable cost, on the other hand, has a different shape, and the average variable cost curve compared to quantities, has an upward slope. So as as quantity goes up, this also goes up, because we talked about how total variable costs were linked with what is being produced. So it has an upward sloping curve, so your average variable cost looks something like this. Notice, however, that this curve, the average fixed cost is going downwards, the average variable cost is going upwards. My question to you then is, what would the total average cost look like in terms of quantity? What would the shape look like? Take a minute to pause the video, think about what the average variable cost curve should look like. And once you've thought this through, you can resume the video, and we'll discuss the shape of the total average cost curve. The total average cost curve is important because if you remember, a firm's prime purpose is to maximize profits, and it can maximize profits by either increasing revenues or by decreasing costs. And when it comes to decreasing costs, it is the total average cost that the firm is actually really trying to reduce. So it is important that we remember, or we can actually plot or graph the shape of a total average cost curve. So maybe for this table we can put a box over here as well and discuss average costs in the context, and then we can talk about marginal costs as well. Let's just see if um, we can do that. No, we can't. Let's just put something over here that blocks our ability to see stuff. Oops. And then let's look at this. Right. So the first column is what is being produced. That's your output, cups of coffee per hour. And then column 2 is total costs, in which there is a fixed cost component and then there is a variable cost component. Let me see if I can, yeah. So fixed cost, notice that it's constant because it does not depend on how much coffee is being produced, right? Whereas the variable cost changes, and you notice that it keeps on increasing as more and more is being produced. So initially, when you were not producing anything, the variable cost was zero, and when you were not producing anything, the variable cost was zero. The variable cost in producing the first good was first cup of coffee was 0.3. Uh, the variable cost, the total variable cost, by the way, was 0.80. Notice how total variable cost is going up. So this is totals, not the cost. So you're not thinking on the margins. But let's just think about the margins. So in order to produce one cup of coffee, what was the total variable? So what was the variable cost involved? What was the cost on the margins? So if you're not producing anything and somebody came up to you and said, "Look, I want you to produce this additional cup of coffee, that 1 unit," variable cost increased from 0 to 0.3. So this cost of producing that one additional cup of coffee is called the marginal cost. And in this case, it was 0.3. So now let's suppose you're producing one cup of coffee, and the total cost is 3.3 rupees, $3.3, which is 3 for the fixed cost plus the variable cost. So now you need to decide whether to produce the second cup of coffee, make it or not. So the fixed cost is the same. if you do end up producing this second cup of coffee, the variable cost is going to be 0.80, and the total cost that the firm is going to be incurring in making 2 cups of coffee is going to be 3.80. The question is, what is the marginal cost of producing the second cup of coffee? So when you were producing the first cup, it was costing you 3.30. If you decide to uh, use the next cup, your total cost is going to be 3.80. So this tells you that on the margins, deciding to increase your output from 1 to 2 will result in the total cost increasing from 3.30 to 3.80. So it feels as if your marginal cost for producing the second unit, the cost of producing the second unit in terms of margins from 1 to 2 is actually 0 point. So you subtract these two and you should end up with 0.5. So to produce this second unit, after you're producing 1 cup of coffee, the additional cost incurred was 0 0.5. So this is your cost on the margins. And similarly, when you decide, so you're producing two cups of coffee and you think, should I be producing the third one or not? Cost increases from 3.80 to 4.50. So there is a change in marginal cost. So the cost of producing that third unit is basically subtracting these two guys and coming up with 0.7. So that's your marginal cost for producing the third unit. This the marginal cost is this last column in this table. It's telling you what does it cost to increase, what is the, so basically the formula for marginal cost is change in total cost when there is a change in quantity, and that gives you marginal cost. So when you change quantity by 1 unit, how much does the total cost change? That gives you the marginal cost. Recall, margins was basically me saying that I'm making 10 things, I want to make the 11th thing. What will it cost me to make the 11th thing, and what is the benefit of making that 11th thing? If the cost is more than the benefit, you don't go ahead with it with making that thing. If the benefits or the price at which that additional unit is going to be sold at is greater than the cost of making it, you go ahead and make it. So that's your marginal cost compared to your marginal benefit. So this is all about marginal cost. Now let's just focus on average fixed costs. So remember that average fixed costs was basically total cost divided by how much is being produced. Average variable cost was average, sorry, I wrote it on the wrong place. Let me just move this as well. Get rid of this as well. Maybe let's stay with this. Right, so what was average fixed cost? So average fixed cost was total fixed cost divided by how much is being produced. What was average variable cost? It was total variable cost divided by what is being produced. What is total average cost? Is basically total cost divided by what is being produced. And marginal cost, as we discussed earlier, is the change in total cost when there is a change in quantity produced. So let's talk about average fixed costs. What's the average fixed cost when you're producing nothing? So when you can't calculate average this way. That's why this row over here is because anything divided by 0 is a problem. So let's talk about fixed cost in this case now. So total fixed cost is $3 divided by 1. So you should come up with an average fixed cost of 3. How about the variable cost? So you have a total variable cost. This thing is 0.3 divided by 1. So you end up with an average variable cost of 3. What is the total average cost? You can always add these guys up and you should come up with 3.3, or you could just divide the total cost by the quantity being produced. Similarly, let's just go down and see if we can, if you've gotten this marginal cost we've already discussed is that the marginal cost for producing this first unit is zero point 0.3 because your total costs increase from 3 to 3.33, 3.3 when you produce this marginal good. So let's just remove the box over here so that you can actually, let's keep the annotation and let's move the box a little bit and go back into the slide and see what we were talking about. Notice how we talked about the the second row. Let's discuss a couple more of these rows so that maybe we get an idea of what's going on. So notice, so what we've discussed is that as quantity goes up, variable costs increase, total variable costs increase, fixed costs are constant because they have nothing to do with what is being produced. Uh, as we discussed with the average fixed cost, we talked about how since this was uh, fixed cost divided by quantity, and we talked about how since this fixed cost is fixed and quantity keeps on increasing, this the average fixed cost curve is going to be downward sloping. The average fixed cost curve is going to be downward sloping with respect to the value is going to be basically decreasing is what I'm trying to say as you produce more. Notice how as more is being produced, average fixed cost falls. All you're doing is dividing the fixed cost with how much is being produced. Notice 3 divided by 6 will give you a half. Similarly with variable costs, you divide the total variable cost by how much is being produced. So if you divide 3.30 by 5, you end up with 0.70. Notice that average variable cost is is increasing as quantities go up. As quantities go up, this value is increasing. Ignore the fact that these lines don't make a lot of sense. So this value is increasing as quantity goes up. Whereas for the average fixed cost, this value is falling as quantity goes up. So in the case of total, so average variable cost, you notice that this value is increasing as quantity goes up. It started off with zero point 0.3, it keeps on increasing till it's 1.10. The average cost is tricky because you notice how one is going down and one is going up, and eventually when you talk about the total average cost, it's basically a sum of these two things. The total average cost curve, the total average cost curve has a weird U shape. So in the beginning it goes down, but then it reverts and starts going up, and this is called the total average cost curve. This was average variable cost, and this was average fixed cost. So what we need to kind of look at is, or try to understand is, why is the total average cost curve in a U shape? So first, what we need to look at is, before we get into why this is a U shape, what I want is that we look at how marginal costs behave, and we'll notice that marginal costs are what are also exhibiting an increasing behavior when it comes to production. As quantity of coffees increases, the marginal cost keeps on rising. By the way, how are we calculating marginal cost? Let me just recap. So let's talk about this guy. Where did this guy come from? 0.90. So the total cost of producing 3 cups of coffee was $4.50, and you were thinking about, you decided to produce the fourth or the marginal unit, and that resulted in the total cost increasing from 4.50 to 5.90. If you subtract this, so if you subtract 5.9 from 4.2, you end up with the marginal cost, which is 0.90. Notice that marginal costs are also increasing as the quantity of goods are being produced. So the marginal cost, sorry, exhibits an increasing behavior as well. So this is marginal cost in terms of quantities. The more you produce, the higher the marginal cost becomes. Now with this information, we can actually discuss the shape of the total average cost curve, because this total average cost curve is the one that we're really interested in. But before moving forward, I want you to pause this video, take a minute, look at where what the marginal cost curve look like, what is the data telling you in terms of what happens when quantity or production increases, what happens to the costs. You notice that as production goes up, marginal cost increase, average variable cost increase, average fixed cost decrease. However, for average variable cost, you notice that initially it starts falling to a certain point. Notice this point where 5 and 6 things are being made, and after this, the average variable cost starts to go up. So firms basically want to kind of figure out this point where the average variable cost is the lowest, and then they want to, based on this, they want to decide how much to produce, because if they decide to produce the seventh unit, the average cost starts to go up, and basically we were trying to minimize costs, minimize total average costs. So once again, take a minute, pause this video, look at these 8 columns, and once you feel comfortable with the data over here, move on with the video so that we can discuss why the total average cost curve is uh, a U shape. Right, so before we get into the slides and look at these things, let me just answer the question about why the average variable cost curve exhibits a U shape. And for that, I will turn the screen wide and maybe we can discuss this over here. So we noticed that the average, so when you talk about costs, we noticed how the average fixed cost was was going to be going downwards, and we noticed that that as quantities go up, average variable cost increases. And that we also noticed that the marginal cost also exhibits an increasing sort of behavior. This is the marginal cost. But for some odd reason, the cost over here in quantity on the x-axis, the total average cost goes down first, but then it starts to go up, and that's the total average cost curve. And we're trying to figure out why this is happening. Why does it go down and then kind of revert? So before we go on and discuss this behavior, I want to kind of use an example of our CGPAs to discuss what happens. So let's suppose I'm in the first semester of MBA, and my CGPA is 3. This is my first semester result. In the second semester, I end up of MBA. I end up with a CGPA of 3.5. Sorry, a GPA of 3.5. So let's say this is GPA and CGPA. So since this is the first semester, so CGPA is going to be the same. Because I scored 3.5 in the second semester, do you think that my CGPA will go up or go down? Because I scored something greater than what I scored earlier, I would like to imagine that my CGPA would probably go up. But what if in your second semester MBA you didn't actually score 3.5, you actually scored 2.5? What do you think would happen to your CGPA? Will it go up or go down? Because you scored less than the average from last time, your CGPA would fall to maybe 2.75. So, so when you if you've understood what I mean by what happens to your CGPA based on your marginal performance, this second semester score is how you performed in marginally in the next semester. So with this information, I'm going to be adding a marginal cost curve over here. This is the marginal cost curve. Oops. I'm sorry if that doesn't look like a straight curve, but we have to deal with it. So the idea is that whenever the marginal cost or cost of producing that one additional good is less than the the total average cost in this so so when you look at these two cost curves, you see that when 10 things are being produced, the marginal cost is this much and the average cost is this much. So this is the marginal cost and this is the average cost, total average cost. You notice that, so think of this as your CGPA, which was 3, and then you ended up scoring 2.5. This resulted in your CGPA falling. So whenever your marginal cost or wherever your marginal cost is less than your total average cost, it results in pushing your total average costs down. Or in other words, if your GPA is less than your CGPA, it will cause your CGPA to fall. So think of about this. Marginal cost is the cost of producing that one additional good. If the cost of producing that one additional good is less than the average cost is going to fall. However, if let's say you are producing this amount of goods, at this point, the marginal cost is this, whereas the average cost is when you go from here up to the total average cost curve is maybe this or the same. You notice that in this scenario, the marginal cost is greater than the average cost. The other scenario, your marginal cost is greater than your total average cost. So your GPA is greater than your previous semester CGPA, this will cause your CPPA to go up, or in other words, when marginal cost, the cost of making that one additional good is more than the average cost of producing things in your factory, the total average cost will start to go up. So, what we're basically implying over here is that the average variable cost, the average cost curve is U-shaped, and the marginal cost curve cuts the total average cost curve at its lowest point. This is your marginal cost curve. And what's basically happening is that this is the point, the lowest point, is where the marginal cost is equal to your is total average cost. That's why it's called the lowest point. Beyond this quantity, producing more than this will result in the marginal cost, the cost of producing an additional unit becoming more than the average cost, therefore raising the average cost. And producing below this quantity, Q star, is are going to be, be places where the, the cost of producing an additional unit is less than the average cost that you were earlier incurring, and deciding to produce these quantities will result in average costs falling. So what normally happens is firms start with zero production and they keep on producing. All they're trying to do is reduce their total average costs, and they keep on producing till the point they come to Q star. And Q star is where the marginal cost is equal to the total average cost curve. Until this point, the marginal cost has been less than the average cost, resulting in average costs falling. But beyond this point Q star, deciding to produce Q star, let's say this Q1, would result in the marginal cost being greater than the average cost, therefore pulling the total average cost curves up, and that is what a firm does not want. So firms want to scale, they want to increase their production till the point that they reach Q star, and Q star is also called the efficient scale. So when you go and look back into the book, this point Q star is called the efficient scale. So when you keep on increasing, you come to a point where marginal cost becomes equal to the total average cost. This point is called the efficient scale. And in the slides that follow, we'll discuss how whenever so firms basically want to scale. They want to increase their productivity. They want to increase productivity. They want to keep on producing more. But they keep on producing more till the time, but they keep on producing more, and the idea is that as they produce more, their total average costs will fall. But there comes a point after which total average costs start to increase, and that's a no-no for producing more. And this somehow is kind of linked with variable costs, um, because variable costs are increasing, you're adding more people, but the other equipment, your land, your labor machines are fixed. That's why this marginal cost thing starts to revert. Later on in the video, we'll discuss the fact that this total average cost curve behaves differently in the short run compared to the long run. In the long run, people are able to add to their um, factories rather than just including more workers to produce more. They can expand, and when they expand, the fixed cost increases. And when the fixed cost increases, we'll eventually find out that the total average cost curve in the long run becomes can look something like this, becomes flatter, and firms have can choose. Uh, these smaller curves are the short-run cost curves, total average cost curves, while the longer one is the long-run cost curve. But that we'll see in a minute. Right. I hope we've understood why the marginal cost curve is upward sloping and how it impacts or pushes or pulls. So I hope we've understood why the marginal cost curve is upward sloping and how it plays a role in pulling the total average costs down or pushing them up. With this, let's get back to the slides and continue from there. So this we've talked about total cost curves. Uh, the average variable cost curves we've talked about as total cost divided by quantity. And it is important that we read these slides because they give you important information. This average total cost basically divides the total cost evenly over all units produced. Marginal cost is also something that we've discussed. It is how total cost increases when you add an extra unit of production. When you produce one additional unit, how does the total cost change? And the formula is how total cost changes when there is a change in uh, what is being produced. Um, the shape of the marginal cost curves we discussed because of the fact that productivity exhibits diminishing returns to inputs. The more input you add, there is a diminishing increase in there is an increase in output but by a diminishing level. This results in the cost curves rising. I think I've already discussed this. So the average total cost curve is basically the average variable cost and the average fixed cost. We've discussed why the average fixed cost always declines as output rises. We've talked about why average variable cost typically rises as output increases. And we've talked about the U shape, and that's the quantity that minimizes. So there is a quantity that minimizes the average total cost. That's called the efficient scale. And this is the stuff that we've covered in the previous 2 minutes about how if the marginal cost is less than the average cost falls. So if your GPA is less than your CGPA falls. If your marginal cost is greater than your average cost, your average total cost rises. Um, and the last line over here is important because the marginal cost curve cuts the total average cost curve at its lowest point. This is important to remember. So these are some shapes that we've already discussed. Notice how the marginal cost is always increasing, the average variable cost is also increasing, the average fixed cost falls, but the average total average cost falls, but then it starts to rise. And notice that it cuts the marginal cost at its lowest point. And in this case, the efficient scale basically says that the firm should be producing 5. It's because that's where the marginal cost is equal to the average total cost. So the firm should be producing 5 cups of coffee. So this we've talked about, and what is important to remember is that the fixed costs are fixed in the short run, but in the long run, these costs can actually become variable as well. So, for example, if having a factory is a fixed cost, in the short run, sure, it will cost you $3. But in the long run, maybe you can add another factory into the mix, and that would therefore then become a variable cost. So if for a factory, a long run could be maybe 2 years, but maybe for a coffee shop, adding a new coffee shop might be a month's work, or maybe 2 months' work. So, so the fixed cost may be fixed in the short run, but might become variable in the long run. The fact that this can happen, therefore, means that the cost curves exhibit different shapes in the short run and the long run. So, firms have greater flexibility in the long run. So, you have long run cost curves and then you have short run cost curves. So these long run cost curves differ from the short run cost curves that we discussed, and they're flatter than the short run cost curves. And the short run cost curves are normally on top of the long run cost curve. So when they say they are flatter, what they're implying is they look like this, and the short run cost curves basically lie on top of the long run average cost curves. So firms basically in the long run, because their fixed cost becomes a variable cost, so that's why this long run behavior, the long run cost curve is flatter. So this graph basically exhibits the shape of the, the long run and the short run average cost curves. We've discussed the short run average, the blue ones over here, um, and and um, notice that underneath the slide it says because fixed costs are variable in the long run, average total cost curves in the short run differ from the average total cost in the long run. So if you take a look at this graph, you realize that you realize that the when you look at the long run cost curve, you notice that there is a period in which average variable cost curves. Sorry, there is a period where the average total cost is falling, and then there is a period where the average total cost is constant, and then there is a period where the average total cost is increasing. So the period, so what firms want is they want to scale. Every firm wants to scale their operation. They want to increase their productivity. By scaling, they want to increase production. They, they want to increase the scale of their production. They start off with zero production, but they want to end up producing a lot. And the idea is that when they start off, they experience something called the economies of scale. This is where when they're increasing their productivity, the average costs are falling. So when output goes up and average costs are falling, this phenomena is called the economies of scale. So you must have heard about China, about how they produce at a level so that they can benefit from the economies of scale. So they mass produce so that average costs fall for them. Cost falls obviously, total average cost to a certain point. After this point, there is a period where scaling does not result in the average cost curve going up or down. And this point is called, or this place is called the constant returns to scale. So what you're getting from scaling is constant. Average costs are not falling. And finally, there is a point beyond a certain limit where producing beyond that would result in average costs increasing, and firms would experience something called diseconomies of scaling if they decided to go about and scale. Um, Notice how the short run curves are lying on top of the long run curves. So basically, in the short run, firms are producing on the blue or the short run average cost curve, but in the long run, they can move this way. Average cost curves can move along the long run average cost curve, and this is what it looks like. So economies of scale, long run average cost curves fall, as we've discussed. And the reason for this is people are getting specialized in their specific domains during production. Long run average cost curves, when they stay the same, is called constant returns to scale, even though your output is increasing. So ideally, you want to be in a place where you're running constant returns to scale. Cost is not falling, and but it's not increasing either, and you can scale and increase your revenues. Diseconomies of scale is a place where you don't want to go to, and this is where average costs start to rise, and mainly attributed to coordination problems when you're producing on a very large scale. So far, we've covered what explicit, implicit, fixed, variable, and total costs look like. We've talked about the shapes of the average fixed cost, average variable cost, and the average total cost and the marginal costs. So these are some questions that we discussed when we started off with today's session. What is the relationship between the firm's revenue, profit, and costs? So we've talked about how revenues minus the costs give you profit. We've talked about what opportunity cost is, and we've talked about how accountants should consider it as a cost, and we've talked about how economists want to use it because eventually your decision making would be affected by the returns of whatever you are giving up on. If the cost of sitting through this class is too high, uh, you might want to skip it eventually. We've talked about what marginal productivity is, what the marginal product is, and we've talked about what it means when we say it is diminishing. So we talked about how as you produce more, output increases by a certain amount, but this certain amount keeps on decreasing as you add more input into the production process. Drawing, we've seen the shape of the production function. Um, what are total cost curves? What is the average cost? What is the marginal cost? These are things we've discussed. Uh, by this time, we should be able to draw the marginal cost curve and show that it cuts the average cost curve at its lowest point. And we've talked about why the cost curves are different in the short run and the long run, because fixed cost can become variable costs in the long run. And we've talked about the definition of the economies of scale and how they arise because of specialization. And we've talked about this economies of scale and why coordination issues can result in uh, the disadvantages of scaling too much. With that, we stop today's session. Thank you very much for bearing this 1 hour session.